What can you do if you have equity in your house but a bunch of other debts? Ted and I are going to talk about it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
I got an email from a listener. You probably don't believe that.
An email from a listener.
An actual true story. And here's what he said, and I'm going to quote, "I would like for you to make a podcast that would speak about homeowners who have massive unsecured debt and cannot refinance and have high equity in their home." Okay. That sounds a good thing to talk about.
Okay.
Hasn't been much of a thing the last few years. I bet you it'll be much more of a thing in the future years.
Particularly with rates climbing and debt levels going up.
And the real estate market going in the other direction. So
Right.
We are recording this in July 2022. If anybody is watching this in the future and we refer to what's happening in the world, I'm sure the world will be completely different.
So much better.
10 minutes from now. So he gave me a whole bunch of specifics of his situation. I'm not going to quote from his data, but let's take a look at a common scenario.
Okay.
And see how this situation could be an increasing problem in the months ahead for the reasons you just said. Interest rates are going up, real estate prices are going down, unsecured debt levels continue to go up.
Right.
This is somewhat of a recipe for disasters. Now, you might be watching this and going, well, I'm not a homeowner. It doesn't apply to me. Well, yeah, but what about your parents? What about other people you know?
Yep.
It's not at all uncommon for adult children to be helping their parents with advice and...
Well, and all of this stuff goes in cycles. So you may not be a homeowner today, but the information is still relevant.
So let's talk about cycles then. Yep. So as of right now, spring, summer 2022, in fact, going back into 2021, what percentage of our clients own a home at the time they file a proposal or a bankruptcy?
1%, 2%?
That's right. Virtually nobody.
Right.
And why is that? Why is that number so low?
Because the last few years, real estate values have gone up so quickly. And even with the COVID fiasco, people were able to get some sort of relief. So they've been able to either refinance, sell their house. Some way they've been able to leverage the equity in their house to pay off the debts that they had.
Yeah, if your house has gone up by $200,000 last week, and probably not last week,
that's
but
right.
Last year or in the spring or whatever, and your unsecured debts have gone up by $50,000, no big deal. I refinance and I live to fight another day.
Right.
The peak for the Hoyes Michalos Homeowners Bankruptcy Index, which is the percentage of our clients who own a home at the time they file, February 2011. Right. That was a long time ago. 35%. So about over a third of our clients owned a home at the time they filed back then.
And I bet prime in those days was somewhere around 6.5 or 7%.
Yep. And real estate prices were, half what they are today or whatever.
Lower than that.
Yeah, it was a really low number. So you might have, when you came in, you remember 2011, someone would come in to see you, and if they owned a home that they'd bought in the last few years, the equity would be
negligible.
Yeah, not much. $5,000, $10,000, something like that. So we go, okay, you know what? You got a little bit of equity. We'll do a nice little proposal. Everything will be great. But when you come in with $50,000 in debts and $300,000 in equity,
it's not the same situation.
Not the same situation. So, okay, now I got a bunch of questions for you. And once again, you have no cue cards. I have the questions. You get to wing it.
You're completely in control.
I know. I love doing it this way. So here we go. I've referred to unsecured debt a few times, so just explain to the listener what do we mean by unsecured debt?
So it's probably easier to explain to you what a secured debt is first, and then we'll do unsecured in comparison, right? A secured debt is something, is a type of debt that's being guaranteed by some underlying thing or asset. So for example, a car loan or a car lease is a secured debt. You don't make your payments on the car loan, they've got the right to come and take your car. You don't make your car lease payments, they got the right to come and take your car. Mortgages are another perfect example, since that's what we're talking about today.
It is.
If you don't make your mortgage payments, they've got the right to take your house. So secured debts, there's something anchored to the debt, and usually that means they've given you a better interest rate too. Unsecured debts, there's nothing attached to the debt. So the credit has been granted to you based on the strength of your own credit report, your own credit history. They're saying that we believe that you're good for this money, but they have no special rights if you don't make the payments. So an unsecured debt, typically a credit card, a line of credit, overdraft at the bank, income taxes, any type of debt.
You forgot one.
I'm not going to talk about that. He's talking about payday loans, folks. He's trying to push a button.
Yeah. Which the email I got from this person, he said, I always love it when Ted talks about payday loans. He gets all upset about them. So I had to make sure you mentioned it. So yes, a payday loan is also an unsecured debt. And you're right. It's real simple. Is something attached to it?
Right.
If it is, it's secured. If it is, if it's not, it's unsecured. So if we look back over the last year or two, what is the typical amount of unsecured debt that one of our clients would have at the time they come in to file a proposal or a bankruptcy?
So the average person calling us owes about $50,000, and that's a combination of credit cards, income taxes, loans, that sort of thing.
And if that person owns a house, and we've already said that virtually none of our clients over the last few years have owned a house, but of the 2 or 3% that did, would their unsecured debts be higher or lower?
Well, they were higher. My recollection is somewhere at 80, 90,000.
So why do you think that is? Why is it? Because if I don't own a house, my average debts are around $50,000 unsecured. And if I do own a house, my unsecured debts are around $86,000, according to my notes here.
So I was close.
So there you go. You don't need cue cards. You don't need no stinking cue cards.
Right.
So why is it that if you own a home, you owe more on credit cards, bank loans, income taxes, all that other stuff?
Well, that's because you own a home. You've got more expenses. But I mean, the underlying issue is that probably if you own your home, you're at a better place economically as far as income goes, status of your life, all those sorts of things. And the better off you are, the more in debt that you incur.
So it's not just the mortgage, it's everything else as well. Because, you buy a home and, you know what? Now I got to get a new fridge and I got to paint the walls and put a new roof on everything else.
Years ago, and I'm talking 20 plus years ago, we calculated that when you bought as opposed to rented, your costs went up by 25%. That's just the difference of because all these other things you're now responsible for. And I don't know if that's accurate anymore, but it's still, it costs you more to own a home than it does to rent an apartment.
Well, and that's an interesting exercise for everyone listening to crunch the numbers. If you own a home or if you know someone who does, what is the difference between owning and renting? So even something like your hydro bill is higher if you live in a 3,000 square foot house than if you live in a 1,000 square foot condo.
Well, on top of that, the condo, if you're in some kind of tower that's stacked up, you're kind of sharing heat amongst people. That standalone house, it's going out your windows.
Yep. And then there's all the other repairs and maintenance things you have to do and all the rest of it. So it's not surprising that not only are you able to get into more debt because you're a better borrower. Hey, you own a house, we're willing to lend to you, but you also have more opportunity, more need perhaps to do that. So, okay, now, and just another stat here, which is also kind of interesting, our typical homeowner client, and again, not very many of them, $86,000 in unsecured debt, but $120,000 in consumer debt, which would include things like car loans.
Yeah. So they've got $86,000 in credit cards and loans, and they got $35,000 worth of car payments,
which is one car,
or boat payments, or toy payments,
or whatever. Yeah. But it would be primarily cars. So okay, so let's do some math here. I want you to give me the simple answer and the complicated answer. Okay. If I have a house that's worth $1 million and I just bought it yesterday and I put 20% down, how much is my equity?
So the simple answer is you got $800,000 in equity. Let's call that gross equity. The more complicated answer is more realistic. What would it cost you to sell the house to get at that equity? Probably you're looking at $50,000, $60,000, $70,000 worth of fees. So your gross equity is $200,000. Your net equity might only be $100,000 or $150,000.
And it also depends on, is there a penalty to break the mortgage when you sell the house?
There's all sorts of clauses everybody wants their money from you.
Everybody wants your money. So the question today that we're answering is, what can you do if you have equity in your house but a bunch of other debt? So one of the answers is, well, you could go bankrupt.
Right.
So walk us through what happens if you own a house and go bankrupt. So let's start with that example that we just gave. Okay. $1 million house, $800,000 mortgage.
So the responsibility of your trustee, if you have equity in a house and you file a bankruptcy, is to turn that equity into cash. It's called a realization. So the idea is we take the things that you own, the ones that we're allowed to take, we turn into cash to pay off your debts. So in this example, we'd take that $1 million house, we'd sell it. We wouldn't get $1 million for it because it's a trustee selling it. We'd have to pay all of our costs, so maybe we get $100,000 out of it at the end of the day. And that would go into your bankruptcy for the benefit of the people that you owe.
So someone walks in to see you today and you do all that math and there's $100,000 that you think you would realize by selling the house. And you're right. If you sell your house yourself, you put a for sale sign on it.
You'll get a better price than I will.
Right. Because we sell it and we have to disclose that the vendor is Hoyes, Michalos and Associates Inc., bankrupt for the person who's bankrupt. So it's like, well, I'm not paying full price then because I don't know, there might be something wrong with it. They probably haven't done the repairs. It probably doesn't have a new roof, whatever.
These guys are in a hurry.
Right. They have to sell it, and they don't really care if they get the absolute top dollar. They want to sell it.
Right.
So we're going to probably get a bit less. And yes, we have to incur the cost to sell it, obviously. So, okay. So somebody comes in, you do the math. There's $100,000 that you think you would get.
Right.
Obviously, you're going to talk to them about doing a proposal instead of that.
That's right.
But let's assume that the person has too much debt. There's no way they can do it. The house,
cash flow doesn't support.
Cash flow doesn't support it. They've got to sell the house. So how exactly does that work in a bankruptcy then? So are you, on the first day the guy goes bankrupt, he's got to leave the house, or how does it work practically?
And so before you actually make the commitment, you file the bankruptcy. All of those things need to be negotiated and worked out. So, I mean, in our experience, it's, all right, we want you to start looking for a new place before you even file, so you have an idea what your costs are going to be, so you can put together a budget. And then it's, all right, you need to file the bankruptcy now. They're garnishing your wages, whatever. We're going to get it started. But you need to realize before we get this thing through, the house will be sold. And so we'll work out what's going to make sense for the family.
Yeah, and again, you definitely want to be doing this in advance.
Right.
So now let's say that my parents have some money and they want to help me out.
Okay.
And let's say I've got, I don't know, $200,000 or $300,000 worth of unsecured debt. They can't help me out that much.
Right.
I've got a house that you've done the math and the equity is the $100,000.
Yep.
So my parents say, look, we can't give you $300,000, but we could help you out with $100,000.
Sure.
So back to the bankruptcy scenario, what could happen in that scenario?
Well, so we got a couple of different options. The first could be your parents could lend you that $100,000. You could then buy your equity from the trustee. The house doesn't have to be sold. The difficulty with that particular procedure is the courts have decided that you're not entitled to deduct all the costs that I would normally incur if I was selling the house to somebody else. And so that $100,000 might not be enough if you were buying the equity back from me. So it might end up being $150,000. It could be that we should sell the house to your parents. They use that $100,000 down. They get a mortgage they port your mortgage over, and then they just let you rent it. Or maybe we go back and revisit the proposal option where we say, look, your parents are willing to give you $100,000 as a second mortgage. We'll offer that to your creditors as a proposal, as a lump sum payment to get it done. They'd probably go for that.
You hit on a couple of issues there. So the first one was costs.
Yeah, it gets complicated because the courts made what, in my opinion, were some bad decisions in the past. They've basically said that if you are actually selling a house, then all of the costs incurred to sell that house are allowed to be recorded. Makes sense because you had to pay them. But then for some reason, they said if you're not selling the house, you can't claim the cost because you didn't actually pay them. And I don't think that makes any sense, but that's the current state of the law.
So the obvious cost would be real estate commissions.
Real estate commissions, interest on breaking the mortgage, legal fees. I mean, it adds up to a pretty significant number, and it makes a big difference.
Yeah, so if we're talking about $1 million house, and if real estate commissions are 5%, that's $50,000.
Yep.
And I mean, I will take the position of the court here just to make this a more interesting podcast. And I assume what the court was thinking is, well, wait a minute, your parents are going to buy the house from you or finance it or pay the trustee or whatever. They didn't incur real estate commissions.
Right.
So, you know, if they're getting a deal, and you're getting a deal, you didn't have to pay those costs. Why should the creditors suffer because you ended up getting a deal?
Yeah. And it's not real money. So nobody can access those costs that they didn't have to pay. So if you were going to try and go out and refinance your mortgage, the bank wouldn't give you any extra money based on those costs that they didn't have to pay. And at some point, the house has to be sold, and they will be paid. I mean, the problem is we've made a decision in our society that there's advantages to people owning their homes. And we could argue about that one in a different show because I know we're on different sides of that fence. Mm-hmm. But you can't, with one hand, say we want people to have home ownership, and then the next one penalize them for finding a way to stay in their home when they get into trouble with debt. Just doesn't make sense to me.
And if anybody's watching this show on YouTube and you'd like us to have that argument, put a note in the comments and perhaps we'll argue about...
Listeners, send an email.
That's right. Is homeownership really that good an idea? Now, there's another nuance to this in these court cases,
right,
some of them which are quite recent from 2022, where the court says there's a difference between today and tomorrow.
Right.
So explain what the court's talking about there.
So this one is equally frustrating. I mean, there's more of a basis for this in, I guess, being equitable to all parties than the first thing we were talking about. The court says now that, so let's say there was no equity in your house on the day you filed the bankruptcy. So instead of the $100,000 we calculated here, we determined that because of a second mortgage or whatever, there's no equity or very little. But your bankruptcy for some reason runs for 21 months. Your income was high enough, you had to pay some extra penalties. And at the end of that 21 months, it turns out your house is worth $1.25 million. I'll say, so now there is $250,000 with equity in that house that didn't exist on the day you started the bankruptcy. And the court says, well, that's an after-acquired asset. And they've been saying that they have a right to go after that money.
And this was a much more common scenario in 2018, 2019, 2020.
3 months ago.
Yeah, right. Where at the start of the bankruptcy, there was virtually no equity.
Right.
Like you say, maybe it's because I just bought the house, I'm mortgaged to the hilt, I got a first mortgage, a second mortgage, a HELOC, whatever. And so the trustee goes, well, I'm not going to seize your house because if I did, I'm not getting anything for it.
Right.
But then as time goes on, the price of the house goes up. And of course, the mortgages are being paid down.
But even if you don't reduce the mortgage much, because in 2 years you won't pay down much of a mortgage, the fact that the market has increased 25% per year for the last 2 years, suddenly you got all this equity.
Right. And so the court has said, oh, guess what? An after acquired property means exactly what it says. Any property that you acquire after the bankruptcy starts.
Right.
So if you were to get an inheritance, well, that's after acquired property.
And it falls into a different category altogether, so it's a bad example.
Right. But so let's stick to the example here then. The house has gone up in value, and so the courts have said, yeah, sorry, you're not discharged yet, so the creditors are entitled to that increase in value. So how do you get around that? What can a bankrupt do?
So the first would be file a proposal, right? The second would be arrange to have some sort of transfer of title of the property right at the get-go. So in the example where your parents were going to give you that $100,000 to buy out the equity we were talking about earlier, either maybe they buy the house from you or they buy your share of the house from you, or your spouse buys it and they finance it some way that it's no longer in your name. It's got to be done for fair market value, so you can't play any sneaky tricks here. But if it's no longer in your name, then if it goes up significantly over the course of the bankruptcy, it's not after acquired asset because it's not your asset.
Yeah, and the example you give of having your parents buy it, that's probably the most bulletproof way. Or maybe it's, a friend of yours who's going to rent it back to you, but it's an actual sale. So you're right. We would want to have an appraisal done on the property, maybe two of them, so that nobody can question it later. We'd want to know exactly what's owing on the mortgage. We do all the math, figure out, in a bankruptcy scenario, if I was to sell the house, this is what I would get. So long as that amount of money comes into the estate and then title actually transfers, you actually sold it to them, well, then it's gone. It doesn't matter what's gone up in value. Of course, that's easier said than done.
It is. And and it can be complicated. My parents are all in their 80s. And so if I tried to convince them to do something like this, they'd look at me sideways. But it also, and so in some respects, it's more complicated because you got to do a buy and sell of the house. In other respects, they don't have to worry about registering mortgages or anything like that because they own the house. They don't have to worry about you paying them back because they own the house. Of course, now you're paying them rent.
Yeah. Yeah. So if your parents have enough money in this scenario to drop $1 million to buy your house or whatever the number is, or they have the ability to arrange mortgages and everything, great solution.
Right.
But in most cases, that's not
available to most people.
It's just not a thing. Now, I mentioned an appraisal, and I think we all understand what that is. Well, I guess maybe we don't. So let's talk about that. So what is the difference between an appraisal and a comparative market assessment?
Right. So, and the comparative market assessment is often called a letter of fair market value too. It means that the realtor is going to look at half a dozen listings similar to yours and say, this is the range that they've sold for. I'd list yours at this price. It would probably sell between A and B. An appraisal, they're actually going to come through and they're going to take a qualitative analysis of your house. Okay, it does need a new roof. It's got a finished basement. You got a car and a half garage instead of two. There's, all the things that will assess what is this property really worth. It's the sort of thing that's done before a mortgage company will approve you for a mortgage. They want to know what this thing is really worth, whereas the first item was, this is what it's probably worth.
Yeah, one is more detailed than the other.
Right. One will cost you money.
Exactly. So most real estate agents are willing to do the second kind, the comparative market assessment, which is, in a lot of cases, it's one page.
Yeah, it's an email.
I looked at your property online. I drove by it because I know roughly where it is, and I think like you said, if we were to list it, we'd list it for this and it would probably sell for this.
Right.
Whereas, excuse me, the appraisal is much more detailed, certainly a walkthrough, more analysis, whatever. Now, there's a third thing, and I just got it. It's sitting on my desk there. This thing I get from MPAC.
Yes, Municipal Property Assessment Corporation.
And it says my house is worth this much. Well, in my case, my wife's house, because she owns it, is worth this much.
Yeah, that doesn't mean anything. It's often years out of date. So what that number is used for is your property tax assessment. And they're supposed to be adjusted to market rates. But so what happens is, let's say your wife just bought the house that you're in. And we'll pick, it was $750,000 in MPAC before. You bought it for $1.25 million. Well, they'll say, okay, the new assessed value is $1.25, but they'll take 5 years to transition to that, so you don't immediately get hit with a property tax hit. So the property tax, there's a real lag between that and the real value.
And part of it's a game,
right?
Because when you look at that and you go, okay, well, I want my house to be worth as much as it can be, but I understand that this is the number they use to calculate my property taxes.
So you want it to be as low as possible.
I want it to be as low as possible because property taxes are based on a percentage of what it's worth.
Right.
So I know my house is worth $1 million because that guy across the street just sold his, and so the fact that it shows that it's worth $750,000, I'm pretty happy because I'm paying less in property taxes.
If every municipality in Canada were to suddenly actually have market value assessments on their property taxes, it would solve their budget problems. Of course, prices of houses would drop by 10% overnight because people couldn't afford their taxes.
Yeah, you'd be toast right off the bat. So when it comes to a bankruptcy scenario, no, MPAC is not a reliable. Your property tax statement is not a reliable gauge of what the value of the house is.
That's right.
And so if you own a home and if you're in financial trouble, then obviously speaking to a realtor who actually knows what they're doing, making sure you understand what's going on the mortgage, all those things are pretty important. You don't want to be just guessing. No. You don't want to be going online to, I don't know, whatever it is, realtor.ca or whatever, and doing your own
And your trustee won't let you guess. If you're talking to somebody, we have to do a calculation for a reasonable number that will hold up in court.
Well, we want to help you, but the last thing I want to do is take on a bankruptcy and then find out, oh, guess what? I got to sell your house. Sorry, I told you there wasn't much equity. Turns out there is. I mean, we never want to be in that situation.
Yep. Surprises in a bankruptcy are bad.
Never good. Okay, let's do a case study here then to kind of tie this all together. So let us assume that the person has house equity of $200,000. Okay. And let's assume that that's what the trustee would actually get if they sold their house. Okay. So it's the robust number. And let's assume they've got unsecured debt of $100,000.
Okay.
Credit cards, bank loans, car loan, not car loans, taxes, payday loans, whatever. So, and their problem is the interest is pretty high on my $100,000 of unsecured debt. I can't keep making the payments, so I'm starting to fall behind. What are my options?
Yeah, so I would still, where we would start is look at whether or not, can they refinance? So would they qualify for a second mortgage, or could they refinance their first? That $200,000 worth of equity, well, if it's 10% of the house's value, they probably can't refinance. If it's 40% of the house's value, then they probably can. So we'd look at that first because that's a reasonable place to begin.
So let's talk about the refinancing then. Yep. And so we would suggest you talk to someone who is an expert in that.
Right. Talk to your bank.
Or a mortgage broker or whatever. I mean, we've had Ron Butler on the show before. The bank knows you.
Right.
So, and if you already have your first mortgage with the bank, then it may be a relatively simple matter for them to bump up the first mortgage.
Right.
Or they've already got registered, might not be that hard to do a second mortgage, a HELOC, something like that. A mortgage broker can shop the market and can go to a whole bunch of different lenders.
Including private funding.
Right. And the bank has rules to follow.
Right.
And the rule is we're only going to lend up to this percentage of whatever the house is worth.
Because they have to prepare. If something goes wrong, are they going to be covered?
And they're also looking at what your income is, a bunch of other factors. Whereas a private lender might go, I don't care what your income is. I only care what the house is worth.
Yeah. I know that Doug is going to do what he can to keep the damn house. Everything else will go in the pot, but Doug will keep the house.
And so there are some private lenders who only care about the equity in the house. There are some private lenders who only care about your own income because that's what you're going to support it. Right. So a mortgage broker can get you perhaps a different deal than what you would get at the bank. So that's the first step.
Right.
Figure out what is the house worth and then talk to the appropriate lenders to see if it's possible to refinance.
Yep.
Now, let's say that either they say, no, you don't have enough equity. We only lend up to 90% loan to value and you're over that limit. Or they say, yeah, sure, we can give you a second mortgage. The interest rate is going to be a gazillion %.
Yeah, that's the thing to watch for.
Which is just going to make it even worse.
Yep.
And some of these, well, a lot of the second tier lenders now who aren't banks are in the second mortgage business.
Yep.
And the interest rates are very, very high. So,
folks, you know what high is. The second mortgage at 11 or 12% is considered reasonable. A second mortgage at 15 to 20% is not unheard of.
Well,
so you've got to stay out of those markets.
And I've seen them at 30%
yeah,
and
that's
40%.
not a second mortgage anymore. That's,
right.
They're buying your firstborn.
Right. Yeah. And so it's like, whoa, that's how did this happen? So, okay, so let's go back to the options then. So obviously the first option was that you just keep paying, but we already decided that you can't afford that. The second option is to refinance by getting a second mortgage or a HELOC or something.
I mean, you have to have the conversation, even though you probably don't want to, is your answer to sell the house? If you sell the house, you get your $200,000 out of it, you pay off your debts in full, and you got $100,000 in the bank. That might financially make the most sense. Problem with this option is you got to sell your house. So if your kids are in school or you like the neighborhood, I mean, there's all sorts of reasons why you don't want to sell a house.
Yeah, you've got a dog, you got a cat, you can't go to a place with no pets, whatever.
Well, and if you pay off all the debt and you're left with that $100,000, it may not be enough for a down payment on a new house. And so, I mean, it could be that that money will disappear because you use it on something else.
Yeah, you're almost for sure renting.
Right.
And can you find a place to rent? How much are rents?
Yep.
Now, as we're recording this, like I said in July, the market's just all over the place.
It's crazy.
So real estate prices in a lot of places are going down fairly quickly.
Well,
rental rates, though,
they
haven't cratered. In fact, in some cases, they're going up. And part of that's because, well, people are selling their house. They need a place to rent. More people renting. But again, it's all over the map. It depends what city you're in. It depends. Are you looking at a condo, a house? I need a 3-bedroom house, whatever.
Yep.
So it may not be as simple as, I'm just going to sell the house and find a place to rent. But I totally agree with you. And I think that's something you absolutely have to consider.
And we have that conversation with anybody where this is a real example as opposed to just a hypothetical. And it's always the most uncomfortable part of the conversation because nobody wants to sell their house, but sometimes it's the right answer.
Yep. And so what I tell them is, this is not a theoretical discussion here. Right. This is a practical, actual thing. So what you want to do before you make any kind of decision is go out and look for a place to rent.
Yeah. What are your alternatives?
You got to compare two different options. So you know that staying in the house, this is what it's going to cost you. How much would it cost to rent? So, okay, my kid is in this school. I'd like my kid to stay in that same school district. Right. So how far away can I move and still have the kid at the same school? How's the kid going to get to school? All that kind of thing. I've got a pet. I've got, whatever. So what is actually out there? I remember a few years ago having this exact discussion with one of my clients, and they ended up selling the house and they were able to rent a house on their street, just down the street, because somebody was
just lucky.
Yeah, they got lucky. The person who they knew was, got a job in Europe for a couple of years. They didn't want to sell their house. They said, great, we'll live in your house for a couple of years. So they actually were able to pay less on a monthly basis because all they had to pay was the rent. Yep. They didn't have to pay property taxes and maintenance and everything else.
So everything worked out well.
Worked out fine for them. Now, does that happen all the time? No.
Right.
It's much more likely that I got 2 kids and a dog. I need a 3-bedroom house. There aren't a whole lot of 3-bedroom houses to rent. What can I do? But I totally agree. If you can sell the house, particularly if you think the market is going to continue to fall, then not a bad idea right now. So, okay, you could keep paying, you could refinance, you could sell the house. We already talked about going bankrupt, which probably means you lose the house.
Well, somehow you got to come up with that $200,000. So
right. So the final option that you've alluded to many times would be a consumer proposal. Now, in this particular case, we've got house equity that is more than what's owing on your unsecured debts. Right. Is a consumer proposal still a possibility?
Sure. It just means you're going to have to offer to repay 100% of the debt, and that might mean the $100,000 that you owe, or it might mean $100,000 plus all the costs of the proposal. It depends on how generous your creditors are going to be. I mean, normally we would start by saying, you got $100,000 in debt, we'll offer to pay the $100,000. Then if the creditors might come back and say, well, we want plus all the costs.
Doug and Ted are getting paid here.
That's right.
And in a typical proposal, every proposal is the same. Our fees are set by the government, and we get a base fee plus we get 20% of the money that is distributed to the creditors. Probably
that 100,000 would become about 125. I mean, it works out to the equivalent of getting a second mortgage at somewhere around 12%.
Right. So I agree with you. What we would typically do in that situation is we'd say, here you go, creditors. We'll offer you $100,000. over a 5-year period. And, if your parents are able to kick in the money, great, it can be done quicker. But that way it's, what you've got to pay. In a lot of cases, that's not going to make sense.
Well, I mean, the problem is, so $100,000 over 5 years, so you got 60 months, you're going to be paying $1,667 a month.
And if your current mortgage payment is $2,000 a month, you've almost doubled your monthly payment right there.
So hopefully that's lower than the minimum payment you were making on the $100,000. But the reason you came to see us was you couldn't pay the $100,000.
Right. So unless you've got a very good job, you can afford to do it. Your job is stable. That is not always the correct option.
It's just, it may not be viable.
Right. So bottom line then is what we do is we take a look at with you all the different options, make sure you've crunched the numbers and understand what the different options are.
And then you pick the one that makes the most sense for you and your family.
There you go. So I think that's an excellent place to end it. There are many different considerations when we're having that conversation with people though. So, do you plan to move in the future?
Right.
Because if, I'm going to be getting a job in Alberta, okay, well then selling the house makes sense because you're going to have to sell it anyways.
And the kids are done school in 2 years or,
Exactly. I'm planning to downsize anyways. Yep. I was going to downsize next year. I just downsized a year earlier. And if the kids are moving out, this might be a good opportunity to get the kids to move out. Kind of hard to do with a 12-year-old, but easier to do when they're a little bit older. I think you also have to take a look at what repairs are coming up on my house.
That's right. You got to do the roof every 20 years. You got to do the heating and ventilation every 15. You got to replace your appliances every 10.
Well, and I may know that I'm going to have to do the roof pretty soon because it's in bad shape. How much is that going to cost? Oh, yeah, the foundation leaks. How much is that going to cost? So there's always cost to there.
Right.
So it's doing the cash flow between the two options. And then I guess also making your bet on what the future looks like.
Well,
and that's impossible to do. So I don't factor that into the consideration.
And we can't tell you what's most important to you. So you've got to decide too. All right. Is the house so important that I'm willing to take on all of these extra obligations, these extra payments to find a way to make this work? Or would it make more sense for us to sell the house and reset and, effectively start over?
Yep. And in fact, in a lot of cases, living in a smaller place with a much smaller monthly cost, okay, maybe it's not quite as nice as my house, but my stress level is way lower.
Right.
Because there's that much less cash. I don't have to be working double overtime shifts just to be making all the payments. I like your term reset.
Right.
I do that. We're not talking about the rest of your life here. No. I do that for 2 or 3 years. I get through my proposal, whatever it is. I pay off all my other debts. I start to save again. And if 3, 4, 5 years down the road, I want to buy another house, okay, well, then that still becomes an option.
Nobody wants to hear this, but 11% of all Canadians become insolvent at some point in their life and file either a bankruptcy or a proposal. It's just, you're not going to go to a barbecue this weekend and talk to anybody about it, but it's the truth. So it's 1 out of 9 people.
Yep. And the number of insolvencies have been really low over the last few years because of...
It's going to catch up.
It's going to catch up. And I think real estate is one of the prime drivers in that. As,
right.
Again, interest rates up, real estate prices down, can't use my house as an ATM anymore. And that's where the problems come in. So, So there you go. Hopefully we've given you a bunch of practical advice. Again, you can go to our website, hoyes.com, and read about all this kind of stuff. I will put links in the show notes as well to everything we've talked about. And I suspect this will be a topic we will be discussing again many more times over the next year and a half. So hopefully that was of assistance to everyone. That is our show for today. That was Debt Free in 30. So until next week, thank you for listening. I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30. 33. It's 33. 33. Okay, there we go. I think we need a teaser for that because...